Started the recording. Okay. So we'll continue today with, so we have this sheet where we had got started on hedging. Okay, so I've just noted down what we covered the other day. Now we will start, what we will do here is, there are some problems with the connection, I think. I don't know whether it's maybe a Geo5 problem. Okay. Anyway, we're not going to use that. So what we had been discussing from the previous day is we started a little bit with chapter 3 and 3.1, and I would ask you to read 3.2. So we had the discussion on, we just started discussing hedging. Right. So we had just started discussing this, but we'll come back to this for some of the examples. But I think what we'll do now is we'll just go. I'm gonna share some notes with you after the class. This will start now going into the theoretical foundations of into the whole theory of hedging, for which we will refer to these notes. Okay, so this I will put into your notes folder after the class is over. Okay, if I don't do it, please send me an email just to remind you, just to remind me. We're trying to get into things like we were talking about. Um, good that I can. Rajat is also not on mute, but this is Rajat. Rajat is actually, this may be a different, well, I don't have a choice to mute. Anyway, so let's look at this. We had we just rebooted this. We were starting to look at these. The questions we were discussing on in the previous class is here. We started discussing about hedging and we started recapping some of the concepts of hedging, but we'll start once again from the beginning and quickly get into this. We will move quickly through this. And so you read these two sections, 3.1, 3.2, and we'll come back to it. And then mainly we'll be covering it from this note, which will go into your into your note. So here, what I've done in this note is I've tried to make it a very comprehensive note. So it includes some repetitive, some of the units which are included in this note are repeats from what you've already studied, but they've been put into this note so that the note itself is quite self-contained and comprehensive. Okay, so some of the stuff you guys already know. I don't have to go through this. Okay, so things like base asset, terms asset, transaction dates, and settlement dates. You're already familiar with this stuff, but you need to know these concepts in order to do the rest of the stuff in the note, in order to cover the concepts. So these two. So we go to position exposure. This already you're familiar with what this means. Okay. You have been trading already for a couple of projects, so you're familiar with what it means. But in order more technical definition, because most of the books actually don't define what this exactly is. So it's actually, this is how I've defined it. You can read it. You don't have to memorize this stuff. I'm not going to ask you what is a position, okay? But you should try to get a sense of why the definition is given in the way that it is, okay? It is, so basically, you should start thinking of a position or exposure. Position, exposure can be used almost interchangeably, these two words, okay? Now, you should start thinking of it instead of buying something. In the past, we had actually talked about position as purchase of base asset and sale of terms asset. Okay, simultaneous, obviously, because when you buy one, you sell the other. So it's a purchase of base asset or purchase sale of base asset, either you purchase it or you sell it with respect to the base asset, and whatever you're doing with respect to the base asset in that transaction, the opposite is being done with respect to the terms asset. Okay? So that's what we had been working with as a definition. Now I think we should expand the definition a little bit, because technically when we do a transaction in futures contracts, for instance, when we buy oil futures, so you'll see so you see an example here. We'll still use these 3.1, 3.2 examples. Okay. So when he's talking about, let's say here, okay. Right. So when he's talking, okay, so when he's talking about here, when he's talking about hedging with oil futures, okay, so notice that crude oil price, the company can hedge its exposure by shorting 1,000 futures contracts, okay, because the position is for underlying position for 1 million barrels, so 1,000 barrels per contract into 1,000 contracts. Now, when we say shorting 1,000 futures contract, what we mean actually is that obviously we say that I sold 1,000 futures contracts. I went short 1,000 oil futures contracts. So here, this is a market instrument combination, which is crude oil, West Texas Intermediate crude oil. You have to mention the grade. So the market would be West Texas Intermediate crude oil trading against US dollars. And the instrument is futures contracts, okay, market instrument combination. So here the base asset actually is, the futures contract itself. But if you think of the asset being crude oil, you're not actually buying the asset. You're actually just making a bet that the price of the asset will increase, because you're not buying the asset in the sense that you're not actually putting up the money. If you remember what we saw in the case of oil futures, that if you remember, we looked at initial margins. We haven't looked at the exact initial margin for crude oil, but I would tell you from my memory that it's something around 5%. Okay, so whatever be the total value of the contract, the margin is going to be around 5%, which I think I showed you in the calc file that it would be something like that. Okay, so this is what we showed you in the calc file. So the margin would be something like this. So when you buy a crude oil futures contract, what is actually happening is the value of the contract is 47,500. Okay, because you're buying 1,000 barrels, and this is you're buying one contract. So the value of the contract is this. But you're actually not paying this amount of money, and you're not taking delivery of the crude, okay, initially when you do the contract. So in that sense, it could be said that it is not a purchase of base asset, okay, and not a sale of a terms asset. So because of that kind of possibility that you might look at it that way, so it's much better to think of it as in a more general sense. When you think of a position, a position is a bet that some base asset will rise or fall. Okay, so we can actually say, So in the base asset will rise, long position. We can write this way. When you enter longs or when you enter shorts, it's pretty obvious, but I'm just writing it here. Okay. So if you understand now, this is just a matter of using the language, but it's very important to also know how to use the language properly, because you have to be able to think clearly and think through the concepts very clearly. You must have conceptual clarity. That is the requirement of someone who has done an MBA program. You're not just somebody who has risen through the ranks, in the organization without any formal training. So therefore, it's important to use the language properly. So we start now thinking about positions, not so much as purchase sale of a base asset, but in more general terms as a bet that a base asset will rise, the price of the base asset. Okay. Right. Okay. base asset will rise. You make a long position, you put on a long position. So it's a bet that the price will rise or the price will fall. Okay, so when you do a futures contract, you're actually, because you're not purchasing the underlying asset, you're actually just making a bet, and by way of securing your bet, you're putting up this margin. Okay, so that's why when you go to the casino and make a bet, they ask you to buy the chips first. So you buy the chips, pay the money to the casino, and then you put the chips on the table and place your bet. And so it's the same kind of, in a similar kind of sense, you're not actually buying anything, you're placing a bet that the price of crude oil will rise if you buy the contract. Okay, and then as a way of securing your bet, as a way of securing your performance, in case the bet goes wrong, the house or the casino, in this case the exchange, is taking a deposit from you. This is like a good faith deposit. This is meant to ensure that you, if you walk away from the contract, then these guys can actually recover the loss using your deposit. So this is a new way of looking at positions. Okay, that it's a way of a long position is a bet that the base asset will rise, the price of the base asset. A long short position is a bet that the price of the base asset will fall. Okay, and so that includes actual physical purchases as well, because obviously when you're making a physical purchase, also you're making a bet that the asset will rise, and sale as well. We have a symmetrical argument for the sale, right? Now, appreciated value. So this basically, so the position is a bet, and it creates a risk. So every position creates a risk. So position creates an exposure or a risk. Okay, when you take a position, it creates an exposure. So I should rectify what I said earlier, that you can use them interchangeably. They're not exactly the same actually. Although we do use them, but a position is a better way to think of it, is that the position gives rise to an exposure. Okay, taking a position gives rise to an exposure. Let's put it this way. There'd be better use of the language. Taking a position gives rise to an exposure. Okay, and what an exposure means is, the exposure simply means that, in technical terms, the exposure means that because of the fluctuations of the price of that asset, the price of the base asset, the value of your position can depreciate or appreciate. Therefore, it leads to mark-to-market losses or mark-to-market gains. But mainly when you're looking at risk, when we talk about risk, we talk about risk in a symmetrical way. That is, we talk only about losing money. Making money, we don't treat as risk. So when we're talking about risk management and we're talking about risk, we're using the word in that context. We are talking about the possibility of losses only, not the possibility of profits. Okay, so remember that in theoretical finance and academic finance, usually they think about risk as standard deviation, which is a symmetrical view that even possibility of gains is considered as risk. So I'm not using that definition. I don't think it's a very practical definition. It's not the way that people think about risk. So risk should be thought of as asymmetrically only recurring to the downside. Okay, so that's why, so you have a position. A position gives rise to an exposure, which is a risk that the base asset which you bought is going to fall in price. The one you sold is going to rise in price, leading to M2M losses until the position is squared out. Okay, so it's a very big, long, comprehensive definition of a position, but it gives you all the aspects of a position, all the things that happen when you take a position. Okay, M2M losses you already know. Okay, so squaring and closing a position, that also you know what that means. Okay, so here we just so this is basically the thing. Now this distinction that I made, purchase sale of a base asset, typically, so when we do a purchase sale of a base asset, we typically think of what I call fully funded positions. Okay, which is basically the kind of positions that you took in your first semester when you did your first project, where you were buying stocks on a spot basis. So within T+2, T+3, you have to settle the transaction and to take delivery of the asset, and you have to pay the money to purchase which is the purchase consideration. And so you have to take delivery of the asset, so you have an actual purchase of that asset. And so this we call a fully funded position. Maybe we should give it a little name here. fully funded position versus good faith deposits. Okay. Uh, let's make this distinction. Okay, so I lost the connection. Let me check with what is happening with respect to. Okay, the recording is still going on, so that's fine. There seems to be a problem with the connection. Although I'm using a different GeoFi device today from the one I had the other day, but we still have a problem. Anyway. Is there some general problem with GeoFi, or is it maybe just a problem in my area, signal problem?
There is a problem with Geo.
There is a problem.
Yes, it is not working well.
Okay, so even in Delhi, you guys are having problems. Okay, that's very strange. I thought these guys were supposed to be the most advanced connection and all that. Anyway, well, we have to just live with, keep our fingers crossed. Okay. So sum of basis asset will rise. Where is this? Yeah. Yeah. So we are talking about two types of positions, which you should understand how we use the language on this, which is that we talk about fully funded positions, which is where you have to basically cash positions taken value cash or spot positions, where typically you have to fully fund this. Well, not all spot positions are like that. It's a matter of how the setup is organized. You know, the market is organized. It can be even because spot foreign exchange can be done on margin. So you have to look at every transaction. What is the arrangement for that particular type of transaction? Whether it's a fully funded position where you have to take delivery and pay the full purchase consideration, or whether it's a margin position, which is the kind of positions that you had in the case of, you haven't had it so far, you will have it now when you trade futures. So when you trade futures, these are margin positions. These are not fully funded positions in the sense that you do not have to pay the full contract value of 47,500. So it's not fully funded. It is a margin position based on a good faith margin deposit. So this is how we should use the language. So secured by good faith margin deposits. Okay, so that's basically the distinction. So you should always look at. So one of the things you have to look at when you're trading in a particular market is, in addition to all the stuff you have to look at, like what is the base asset, what is the terms asset. Okay, so this becomes another thing to look at. Okay, so let's put a little note here as a revision in a box. Okay, so the settlement type or procedure. Okay, that by settlement type procedure is basically settlement type or settlement procedure, which is given above. Okay, we can call this the settlement type procedure. So what we are saying is when you are investigating any market, okay, so we can talk about affected by the settlement type or procedure. Okay, so you will see that in the Sheldon-Nattenberg book on options trading. Okay, this is referred to as, I should mention this also here. These are important terms to understand and how the market uses this kind of language. Settlement type or procedure. Okay, Sheldon-Nattenberg. Okay, he talks about stock type. Okay, because most stocks all over the world are traded on a fully funded position basis. Okay, so Sheldon-Nattenberg talks about stock type versus futures type if you read that option book properly, which I would recommend if you want to get a good grip on options trading, stock type purchase versus futures type settlement, okay, is what is the terminology that Sheldon Attenberg uses. Okay, so if you so what Sheldon is meaning is implying when he's talking about stock type versus futures type settlement is basically this. He's saying stock type settlement is a fully funded position. It gives rise to fully funded position, whereas futures type settlement is a daily settlement of the profit or loss. So that is going to happen when you have a market which is organized in such a way that it works with margin positions secured by good faith margin. Okay, so it does not require full funding of the position. Okay, so what I'm saying here now is that this becomes when you're investigating a market. Okay, so the settlement type of procedure is another aspect of a market that should be sort of noted, okay, when investigating any market. Market instrument combo, which is along with, so settlement type of procedure is one aspect of the market, okay, and then of course you have to look at base and terms asset. You have to look at units, okay, so like gold is traded in units of troy ounce, so the price is quoted in terms of troy ounce, so that's what is meant by units. Then you should also look at market lot, okay, for institutional trading. So base and terms asset, market lot, units. Instrument is understood because it's market instrument combo, but I'll mention it once again. Base, okay, so base asset, terms asset. What are the unit? What is the unit? Okay, what is the market lot? And also there is the element of what is called tick size in the exchange traded market, which is minimum price fluctuation. You should understand that tick size, minimum price fluctuation. And then there is also the element of OTC or ETM, okay, and so all these things you should know about a particular market, okay. These things, when you're investigating a particular market, you should note all these things, including the settlement procedure. Okay, so this is a little bit of a going back to recap this stuff, but it's important. Okay, let's look at it. So we are defining some very basic, sorry. So we are defining some very basic terms here. Long is purchase of base assets, sale of terms assets. Okay, this is again going back to the fully funded type of definition, or you can just replace it as long is making a bet that the price will rise, which I've already given here. Okay, making a bet that the price will rise. Longs. This is very basic stuff. But we are making sure that we have these concepts clear. Okay. Yeah, so that's what I said here. So same thing is the futures markets and CFDs. You can have these margin positions. Okay, CFDs are contracts for difference, which we are not dealing with here because these are not a major institutional type of instrument. Okay, it's also a type of instrument. It's a type of contract, but it's actually like a OTC kind of futures contract. But it's mainly popular for retail customers who are doing spread betting and things like that, which is very popular in the UK. So, but it usually has one retail customer on one end of the transaction. So we are only training you to do, those kind of products where you have institutional players on both sides of the transaction. So here, okay, another set of terms we want to get through quickly, which is bullish or bearish. I think you understand quite clearly by now, but we just want to make sure that everything is clear. Okay, so this bullish means so if I'm bullish on crude oil, that means I expect crude oil to go up, and essentially terms asset will depreciate. So please understand that. Okay, if crude oil goes up, whatever be the, I'm going to use this loading, just take a sip of water. It's crude oil with historical volatility. So I will just remove this. So as crude oil is going up, we say that the base asset is appreciating and the dollar is actually depreciating in relation to crude oil, because now you need 60, now you need 45, 50, $60 to buy 1 barrel of crude, whereas earlier you could have bought it at like $10 or $20. So it is actually getting worse for the dollar. So base asset is appreciating and terms asset is depreciating. Okay. Now usually we use this these two terms to describe a market outlook, okay, which is a market view, which means it's a forward-looking assessment, which it could be wrong. So that's how we normally use it, okay? So we look at crude oil here, and I might say that at this point, I'm bearish on crude oil. So it is not referring to the previous action. It's referring to my outlook for what's likely to happen to this market, okay? And that is that it's likely to fall. So therefore, I say that I'm bearish on the market. So we use these terms, bullish and bearish. We usually mean that we are referring to a forward-looking market view, okay? So sometimes we can use it. We do. Some people do use it. That dollar yen has been very bullish. Crude oil has been very bullish. You describe this period. Over this period, crude oil has been very bullish. But that's a less, I think that's a less preferred way of using the terms, okay? These are just some terms we want to quickly go through. Okay, now let's try to understand this concept as well. We will need all these concepts in this note, in this exercise. So, outright positions, spread positions. Okay, spread are also called differential positions. So, try to understand here. Only OP, okay, is only one type of net exposure to an atomic level market price. Okay, what is meant by atomic level market price? First, let's get this clear. Okay, which cannot be further broken down into component prices. Let's highlight certain parts. Okay, one type of net exposure. We'll just leave out this. We don't need this to be in bold. Atomic level market price, which can't be, which is the basically here I'm giving the definition of the atomic level market price, which can't be further broken down into component prices, which are more important venues for price discovery. Okay. Now, have I discussed this term price discovery with you guys?
No, sir.
I haven't discussed it.
No, sir.
Okay. Now, if you remember, see, I've asked you guys. I'm pretty sure here. There is a part here where functions of financial modeling. You guys haven't read it because it's not in bold. Please read this note. Okay, I'll open it now and see. I'm pretty sure it's here. It's here that we have the term price discovery. Yeah, connect price discovery to the allocation of scarce resources in capitalist economies. So let's understand this concept. So you should have read this stuff because it's all basic notes, which you guys should have, but I guess maybe it was not in bold, so people didn't read it. So anyway, let's look at this. What is price discovery? Price discovery is actually a fancy term for nothing but, oh, there's no heading here. There's a little bit of a problem. Okay, facilitating price discovery. So yeah, so here what we mean by price discovery, let's quickly, this is an important concept actually, so let's try to understand it. Okay, so remember that we discussed market, the functions of markets is, one of the functions, if you read the note, you'll see that that markets facilitate exchange because you're exchanging the base asset with the terms asset. So the market provides a venue, physical or virtual, to exchange two assets for one another, one of which is usually some currency. And so you can say that one of the roles of or functions of markets is to facilitate exchange. Okay, so one of the things to also think about is that whenever you have exchange, there is some information which is generated every time there's an exchange of assets, and that information is obviously the exchange ratio or price, right? So if we look at the sugar market, where transactions are happening and sugar is changing hands against, let's say, Indian rupees in the Indian market. So many transactions are happening, and every time there is all of these are exchanges. Indian rupees are being exchanged for sugar, and every time there's an exchange, there is obviously some exchange ratio, which means either the sugar, let's say if it's trading in quintals, either it's worth like 300 rupees or it's worth 280 rupees or 410 rupees or whatever it is, okay? But there's some exchange ratio always, because when you do the transaction, there's a price associated with it. So that exchange ratio, the price is also the exchange ratio. That is 410 Indian rupees equals 1 quintal of sugar. So that's the exchange ratio. So what happens is that as you look at markets, they are a venue for facilitating the exchange, for exchanging two assets against each other. And every time the assets are exchanged, there has to be an exchange ratio, and that exchange ratio is nothing but the price, which again connects back to the idea that one of the assets in most markets is a currency of some sort, okay, either yen or Swiss franc or Indian rupees. So therefore, that becomes the price. The currency is the one in which the price is expressed. Okay, so you have this price. So price discovery is a fancy term for what happens in one of the functions of markets, which is to facilitate price discovery. But it's very important because it has a larger role in the whole capitalist economy. The scheme of the capitalist economy. So price discovery is basically nothing but this. Okay, so the setting of the price, continuous setting and resetting of the price, the trading which generates the price information. Okay, this is called price discovery. It's a process. Okay, so you can read up later on what the importance of price discovery is for for resource allocation. I'm not going to discuss that now. You should read this note. You should understand how capitalist economies differ from socialist economies. Okay. It's important to understand because in our country also you have some policy debates which are basically centered on this important difference, that how should we allocate resources? Should you have a government authority that gives a little bit of money to this guy, a little bit of sugar to this guy, or should you have free trading between parties and let them exchange the assets between themselves, and then you have a final allocation? So that's really the fundamental. Read this a little bit more, and then the exchanges are driven by the price signals that are coming from price discovery. Okay, and you can connect it to your economics, excess demand, excess supply, and the impact on the price, because as prices go up, it attracts more supply. As prices go down, it attracts more demand, and in this way, the dynamic keeps playing out. Okay, so this is how I read up a little bit, try to understand it. Okay, but here in price discovery, there is a concept of all markets are not the same. Okay, there may be many markets where price discovery is happening. All right, so let me try and get the Netanya prices up again. We keep needing this. LBMA gold price is one, but the main point here is that. So actually, Netanya. Let's go to Netanya. We have those forex rates. Okay. So the point here we're trying to make now, we define price discovery. Okay. We talked. So there is something here called in price discovery. There could be many markets. Okay. There could be many markets where. Where a certain base asset is trading. Okay, so gold could be trading in various kinds of markets where gold is trading against, which is what I'm trying to show you now. I'm just trying to load that website. Metals. Yeah, okay, so let's just try and look at this a little bit. here what we're trying to talk about in terms of primary market for price. So the new concept that we are talking about is a primary market for price discovery versus a secondary or derived market price or derived market prices, okay? Or derived markets, basically, derived markets for price discovery. So the new concept is secondary markets for primary markets for price discovery versus secondary or derived market prices or market, a price discovery process, which is derived from the primary markets for price discovery. Now, this primary or secondary is not related to capital markets. Please understand, okay? These terms are not related. Primary and secondary here. You better clarify in case there's any confusion. Okay. Primary and we already have the hand. Are not in relation to capital markets, because there's another thing which we have not yet covered, that in capital markets, when you do a taxonomy for capital markets, you talk about primary versus secondary capital markets. So when I'm talking about primary versus secondary markets here, these are not in relation to capital markets, okay? So just remember that when we use these terms. So primary market for price discovery versus secondary or derived markets. Okay. Now, what is the meaning of this? This means essentially that, as you can see here in the case of gold. Okay. So here, yeah, I got the prices here. Let's look at the prices. You see here, the markets are open. So here you can see gold against US dollars. Okay. And you notice the prices are all different because these are all different markets. And why are they different markets? Because at least one of the assets is different. So anytime you have a different asset, that becomes a different market. So, but the base asset is actually the same. So this is the gold rupee market. This is the gold Swiss franc market. So here, the thing what you have to understand, this comes from contextual knowledge, institutional knowledge, that the gold market, the primary price discovery, the primary market for price discovery in gold is what I've given you here. Okay, it's a 24/5 global OTC bullion market, which trades it's pretty much from Wellington all the way to New York, 5 days a week. So this is trading in US dollars per troy ounce. This is the part. So that's why the futures also, because this is the major market. Futures also become quite big now. So the futures contracts were initially when they started. That's why the unit and the futures contract that you saw in gold is 100 troy ounces. Okay, it's troy ounces because they want to reflect the cash market activity. Okay, so therefore they want to make it easily exchangeable against the cash market. So they have the same unit. So this is basically what it is. So the primary. So this is something that comes from contextual knowledge in the sense that. The fact when you go to a country, you discover that when somebody comes to India for the first time, they discover and they want to drive, and they discover that in India they drive on the left-hand side of the road. So this is something that you have to come to the location, or you need to deal with that problem to come to know about it. So once you start dealing in the gold market, you'll discover that the primary market for price discovery is like this one. Okay, so it is usually the these are a lot of words which may seem like these are not relevant, but I think you need to know the terms properly to understand. Is usually the one with the highest volume. Okay, is usually the one with the highest volume. Okay, the most liquidity, highest volume and most liquidity. As you know, volume is a proxy for liquidity. Okay, so this is one thing we can note. Okay, right. So the primary market. So you have to know that this is the primary market for gold is actually against the US dollar, the market against the US dollar, which is the OTC market. Now you also have these other markets. All right. So here what we say is that these are all markets for gold, but this is the primary market for price discovery in gold. So when you are dealing with any kind of risk management problem, I'm just trying to see how we got to this point. before. Okay, we'll come back to risk books and so when you're dealing with any kind of management of risk books, which is either a speculative book or a hedge book, when you're dealing with any of those kind of situations, you have to think like this. You have to think in terms of, because you always want to be trading in the most liquid market. So you want to always be aware of which is the primary market for price discovery. So my point is that if you, let me see if I've written that here. Yeah, I've already written this actually, and then I wrote it. Then I wrote it once again. Okay. So now what is happening here is let me put this here. So I wrote it and I didn't see the note, and I wrote it again. Okay. What did I do? Maybe I should write it here. Maybe I should paste it here. Yeah. So, okay. So what we'll be saying is that whenever you're dealing with any kind of markets, trading or risk management problem, you should be aware of what is the primary market for price discovery. And so therefore what you do therefore is, so in this case, see, in the Indian market, okay, this actually is a secondary or derived market price, which tends to track the international gold price, but there are some distortions because we have a lot of import duties, we have volume restrictions in terms of, so the movement of gold through the Indian borders is actually not free. So therefore, there are all kinds of distortions like import duties, taxes, this and that. So therefore, it's not easy to make these two prices converge. But the main point is that the main driver of the gold price, India does not drive the gold price, although we are one of the biggest consumers. We don't drive the gold price. The gold price is really driven by speculative trading in the US dollars versus gold market, which is here. So therefore, what the point I'm trying to make is, if you have a gold, but maybe rupee is not a very good example because we are not a convertible currency country. So the point here is that if you have a, let me see if I've given an example here. Yeah, let me see what we have written here, okay? Yeah. So let's look, I've given it here, so I don't have to write it again, okay? So now you understand what is a primary market for price discovery. So what we're trying to say is that you need to have one, in order for an outright position, you need to have one net exposure, okay, to an atomic level market price. What is atomic? Atomic means essentially that it can't be broken down further, because this is before quantum physics came around. These terms were invented, these terms started to be used, and now we haven't changed it. So even today, what we mean by atomic is something which can't be broken down further, okay, the most basic level. So we can't break it down further into component prices, which are more important venues for price discovery. What do I mean by this? Here, okay. So this one, if we look at this one, okay, we have this here. Here, gold in yen terms. The word gold in yen terms. It's not an atomic level market price because so gold in yen terms basically is so it is like this, that when you have, so gold is written as XAU, if you remember from your chemistry periodic tables. Gold is, I think, aurum. So the symbol for gold is AU, and the symbol for silver is AG, Argentinium. So therefore, silver is in the bullion markets. Silver is written as XAG. Gold is written as XAU. So gold is actually USD, right? So XAU, it's actually Yeah, it's actually XAU USD because let me write it in English here. So because we are not writing this mathematically as ratios, because dollar is not actually dividing it. Okay, so it's XAU USD because this is the base asset and this is the terms asset. XAU USD is written as sorry, it's not XAU USD. We are discussing an example where XAU JPY. XAU JPY, okay, is equal to XAU USD and, okay, let me write it in English because we're not writing it as mathematical ratios, combined with USD JPY. Okay, so this XAU JPY price is actually number of units of JPY required to buy 1 unit of XAU. So it is actually JPY numerator divided by XAU denominator. So if you have this kind of a position, okay, let's say you are a gold jeweler in Japan. The point I'm trying to make here by talking about all these things like price discovery, important market for price discovery, outright position, okay, and spread position. What we are trying to illustrate here, this is an important way to think about positions, okay, that if you have, let's say you're a Japanese jeweler, you're a gold jeweler in Japan and you need to import gold, okay, and let's say the gold, there's an example in your book where they've talked about the benefits or risks of problems of hedging. And they've assumed that in the gold jewelry market, if gold prices go up, then jewelry prices also go up. Something like that. They've assumed that symmetrical relationship. I don't think that's necessarily true. So in many markets, because if the market for gold jewelry is fairly competitive, very close to perfect competition, then you're really a price taker. You can't really set prices. And so it may not move much. So you're stuck with higher gold prices. So if you have, so you have to manage the risk of your gold imports. So the Japanese gold importer, he has an exposure of XAU JPY, okay? Because essentially he's selling in Japanese yen and he's buying gold. Okay, so he has to split it up in terms of when he thinks about this exposure, and he's also going to be buying gold in terms of yen. So my point is that when we talk about primary market for price discovery and outright positions, the point is that the Japanese importer, when he analyzes his risk, he should not be thinking in terms of the XAU JPY market. That means he should not be going in like this. Let's see what they have. Are they following the same syntax here? I've never used XAU. Yeah, they are using that syntax. Okay, XAU JPY. Let's look at this. Right? Now, he could technically look at this. But my point is, no, you should not look at it. This is happening. It's looking very similar to the actual gold chart in US dollars because the dollar yen has not been moving much. Now, my point is that the Japanese gold importer, when he's managing his risk, should not analyze the gold yen chart. Instead, he should analyze separately. Separately, he should analyze the dollar against gold, the primary market for price discovery in gold, and the dollar against yen, which is the prime. Obviously, there's only one market here. Okay, so he should separately look at XAU USD. He should separately look at this. Looks very similar, and then he should look at USD JPY. And you see, it's not been moving much. That's why the two charts over there look the same. Because the dollar yen has not been moving much. So the point here is that why should we look at it this way? Because there is no active trading in XAU JPY. Although Netanya is showing you prices, these are actually derived prices. How are they posting these prices? They've got a formula in their spreadsheet which takes the gold dollar and the dollar yen and combines them and comes out with a gold yen price. There is no active market for trading gold against yen. Okay. So therefore, what you should do when you're managing risks in these kind of markets, you don't call this a primary market for price. You don't call this an outright position. A position in gold yen is not to be referred to as an outright position, because an outright position is a type of net exposure. Okay, let's say if you have a net long in the gold yen market, you have net long, but this is not to be treated as an outright position, because it's not an atomic level market price, the XAU JPY, because this XAU JPY can be further decomposed into uh, gold dollar and dollar yen, which are more important, primary markets for price discovery. Okay, so, and these are much more liquid, and there is no liquidity in XAU yen, so you will not get good prices. So, in terms of hedging practice or even trading practice, generally traders don't have this kind of problems, because traders don't even bother with this. They will anyway gravitate straight away to the more liquid markets, so they don't have these kinds of weird problems. So these kind of weird problems come up when you're dealing with hedging, because if the Japanese jeweler's business is he's selling to Japanese customers in Japan, he's going to be earning his revenues in yen, and he is going to be importing gold. So he can't help it. His position is this, that's his position because of the nature of his business. But speculators don't have this problem, because they directly decide to speculate in the most liquid market. So this is the point, that therefore you want to be trading in the most liquid markets. So the Japanese importer of the Japanese jewelry importer, gold importer, should be looking at his position as consisting of this and this, two different positions in two primary markets for price discovery. So it is possible, therefore, that, let's say, the natural position of the Japanese jewelry manufacturer is that he is short gold, because he has to constantly buy gold, and if gold prices go up, he gets hurt. So that he's short. We'll come to this discussion, but here I'm telling you that he's short gold. So he should not think of his position as short gold. Of course, conceptually he should know what his position is at a first level, as a first level analysis. But when it comes down to the brass tacks, the actual business of managing his exposure day to day in a dynamic fashion, not in a hedge and forget, but in a dynamic fashion, he should not be trying to trade in this. He should not be trying to trade in this. Instead, he should be trying to trade in the component market. So therefore, right now it's not so apparent, because as I showed you, dollar yen is not moving, but sometimes dollar yen moves a lot. Okay, so therefore it's possible that in hedging this exposure, if he has a view that gold will appreciate against the yen, if he's worried about that, okay, this is his actual exposure, and this is not an outright position, although his underlying position is short gold yen. But this is not treated as an outright position. It is treated as a spread position, and it can be further split up into two positions, where if you are short gold yen, that means you are short gold against US dollars, okay? And your short gold and short gold or yen means you're short gold and you're long US dollars. You're short gold and you're long yen. That means you have yen in your hands. You have yen in your hands with which you're going to buy gold, and you're worried that the price of gold is going to keep on increasing. So that's why you say your exposure. There's some background noise, just ignore that. That's why you say yeah. So now just Sorry about the disturbance, but anyway, I tried to keep this thing moving. Okay, so I'll give a further example here. And so uh, when dynamically hedging, dynamically hedging means you can hedge and unhedge and again come back to hedge. We'll explain what all this hedging means, but you can hedge and unhedge multiple times. When dynamically hedging a short XAU JPY position, okay, it is possible that at times the hedger may be, so if he's short XAU JPY means he's short XAU long JPY, which can be further split up into short XAU long USD and short USD long long yen. Okay, so that's why you see the long here. Your short XAU comes from here, the short XAU, and obviously if you're short XAU, have to be long USD, and this long USD will cross out against the short USD here. So long USD, short USD cancels, then you're left with short XAU, long yen, because you're short USD here and long yen. Okay, so therefore, basically, when you're the point is that when you're dynamically hedging a short XAU yen position, it's possible that at times the hedger may be, since you're short here, maybe long XAU USD as a partial hedge, okay, but may have kept the dollar yen leg of his open. Okay. So when dynamically hedging a short position, say is possible. So this is the point, that this guy is short XAU yen. So he's separately taking a view, instead of taking a view on this market, he's separately taking a view on gold dollar and separately taking a view on dollar yen. So he might have actually taken a long gold dollar example. He might have taken a long dollar, gold. He might have taken a long position in gold against US dollars, but he may not have sold the dollar yen. Okay, because you sell the dollar yen, then you'll end up with your long yen position. Okay, so it's your short, your long USD, and sorry, he may not have bought the dollar yen basically. So you will be long USD, long gold and short USD here, but you need to square that by buying USD and selling yen here. You may not have done that because you feel this is actually quite well described by the current situation, where if you look at XAU USD, when you look at XAU USD, it seems to be going up, and if you're short, therefore you want to hedge and cover your exposure. But if you look at dollar yen, in the dollar yen leg, your position is actually, you are here, you are short gold and long dollars. Here you're short dollars, long yen. Okay, so if you have a short dollar long yen position and you feel that the dollar is going down continuously, then why would you cover it? You would let it remain, and maybe you think that this will go further down, go below 97, 90, etc. So you're keeping this open. So it's a very long discussion, but ultimately I think you understand what we're trying to say, but it also gives you some important insight on how positions should be managed in, especially when you're doing dynamic hedging, because you always want to operate in the liquid markets. So therefore here you would treat gold yen as a spread position. It's not an outright position. It's a cross between two positions, which is a outright it's outright, the actual position, underlying position is outright short gold dollar and outright long dollar yen. Short gold dollar, short gold and long dollars. And here you are short dollars and long yen. Okay, so these are two separate positions and you monitor them separately. Okay, so and that's why it's possible that you can have one leg covered but the other leg open. It's a long discussion. We spent quite a bit of time, but I think I hope you understood what we are talking about. It's a very simple idea actually, but it gives you the idea of first introduction to spread positions. Okay, so an outright position. So when you see something like this, you will not call it an outright position. You'll call it a spread position because it is a cross between two positions in two important primary markets. And this is not a primary market for price discovery in gold. Okay, so that's what we mean by outright positions and differential positions. Spread position. That's what we mean by an outright position. Okay, it has to be an atomic level market price. And so this we have explained all this now. Okay. Yeah. So therefore, if you have a short position in crude oil, short position euro yen, long Maruti Suzuki common stock, or long S&P 500 index futures, these are all examples of outright positions because they can't be broken down further. Okay. Right. So you can read underlying exposure, hedge transaction, hedge and basis risk if you want to read that later. Now, here you have this will be in case this part is not clear. Now here let's talk about spread positions. Okay, spread positions, you have to understand there are two types of spread positions. You can have an intermarket spread or you can have an intra-market spread. So in the case of intermarket spreads, let me get the in the meantime let me get the to understand intermarket spreads, let me get this thing opened. We'll go to our favorite futures contract, crude oil. We'll try to get that open, and the one time while it's opening, let's talk about spread positions. Okay. Now that you understand outright positions, let's talk about spread positions. Okay. What happens to spread positions, and what are spread positions? So you have exposure to a spread or difference between two atomic level prices in two different markets, where the spread position is constituted by two OPs, long and short, in two different markets. Okay, so here you had like this one. That's an example of an intermarket spread, the one we just discussed. XAU JPY, short position, and XAU JPY is a combination of, is an intermarket spread because it's a combination of two atomic level prices in two different markets. Okay, because the XAU USD is a different market from USD JPY. So a short XAU JPY underlying position for the Japanese jeweler is a combination of, should be broken up into a short XAU USD position, okay, short XAU and long USD, and a short USD and long Japanese yen position, two separate positions. So these are the two separate markets in which you have, so in between which you have a spread. Okay, so the SP is considered opposite positions. So sometimes you can have other kinds of other more logical intermarket spreads which are traded by people, which is, you know, futures traders like long corn and short wheat. You may have different views on the two different crops. Okay, then long gold, short silver, these kind of things when you have a relationship between the two prices. And the example I gave you is more likely to arise in the case of a Japanese gold jeweler who has to buy a lot of gold, but he really can't influence the prices of his jewelry. which is mainly driven by design effects and things like that. Okay, so here you have, so spread position, the first type of spread is a intermarket spread, which you just saw. Okay, and these are also intermarket spreads. Long gold, short silver, very popular trade. And then there's another type, which is the intra-market spread. Okay, this is also sometimes called a calendar spread, time spread, horizontal spread, different patterns. So you have two OPs, okay, outright positions, in the long and short of the same market, the same instrument, but different settlement dates or maturities. Okay, so it's an intra-market spread. So the market doesn't change, but the maturities change. Okay, these are the legs of the spread, and amounts has to be the same usually, for unless you're doing options. So let's show you one example of an intra-market spread first. Intermarket we already looked at. Okay, so intra-market spread would be sometimes also called, as we said, calendar spread, time spread. It's actually also called an inter-month spread. Let's copy this also and put that. So these are quite popular in, especially in the agricultural commodity markets, but you can do them in all kinds of futures markets. Okay, these are more common in futures markets because futures markets are very liquid generally. So here what I would do is, if I have a view that, let's say I'm a player in the crude markets, I have physical crude operations, and I have some information on the actual underlying market, and I feel that based on my understanding of the market, this difference that you see between the July price for crude oil and the October price, okay, this difference here is around 50 to around almost about 80 cents, I guess. 50, yeah, so 80 cents. So this difference, I think this difference is too high. Okay, this difference is going to come down, according to me, based on my understanding of the market. So I make a prediction that this difference is going to come down. Okay, so this spread is right now the near month minus the far month is a better way to define the spread. You can define it any way. So if I feel the spread is going to come down, what I will do is I will sell July and I will buy October. Okay, and I'll do it simultaneously for the same amount. Okay, so maybe 200 contracts, sell July, buy October. Okay, so you can give this order to the broker as a July-October spread, and so you will say that I want to sell and buy July versus October crude oil futures. Okay, so that's how you would give your order. So your commissions also might be a little less for this kind of, rather than doing these two separately. And you will find that when we discuss spread margins, when we discussed margins earlier, initial margins, maintenance margins, the exchange is also going to ask you for less money in terms of margin, because the exchange is not so worried about your risk, because you are short July, but you're also long October. So the spread between October and July, according to the exchange, which is true actually, generally the spreads do not move. I think I've written this somewhere here. Okay, I think I'm pretty sure I've written it somewhere here, but anyway, I'll just tell you guys. So generally what happens is, yeah, so I've written this here. The volatility, you can look at it as either H-vol or anything else. Okay, or standard deviation also of the outright positions in any market will be much higher than the volatility of the spread positions. So if you look at, the point I'm trying to make is that if you calculated the historical volatility or the trading range of the July contract or the October contract you would find that they're quite high on their own. But if you looked at if you plotted the difference between July and October every day, you create a new time series, which is July minus October. And then you take the SD of that time series. That will generally be for the same commodity, for the same market, inter-month spread. The spread volatility will be much lower than that of either of the legs of the spread. So the exchanges also know this, and they want to encourage you. I mean, why should they charge you more if the risk is less? So therefore, what exchanges do is, this is another thing to keep in mind if anybody goes to work for an exchange, that when you're looking at setting margins for spread positions, these are called spread. So this would be an intramarket spread, intermonth, intramarket spread. This obviously you don't set such a high position as you would set for an outright position in July or October. So therefore, the spread positions, you'll see exchanges also charge lower prices, lower margins. They require lower margins because the risk is much less. The price moves much less. Okay, so that's the idea here. So you've learned about price discovery. You learned about the primary market for price discovery and derived markets. So in this case, what happens again is, we go back to this term. In this case, the XAU JPY price is a derived price. Nobody tracks this price directly because there's no direct market. What people do when they have this kind of position is they separately track the dollar gold price and the dollar yen price, because this is where the liquidity is. This is where the activity is happening. So they have taken a spread position, and they know they have the exposure because of their business. But when they are managing the risk dynamically, they don't look at this on a regular basis. They really look at these two prices, and sometimes they may have hedged one leg of the spread but kept the other leg open. Okay, which if you look at the current market situation is what you would do, because the dollar yen seems to be going down. So you would keep it open, hoping to hedge because your dollar yen position, this leg position, this position is short. Short dollars, long yen is your underlying position. So in order to cover that, you need to go long dollars, short yen. But why go long dollars? Why go long dollars now when it seems to be going down? Okay, so this is just my view that eventually it will fall below this as well. But you could also have the view that it's approaching support at 100 and it might actually bounce. So anyway, whatever your view is. But the point is, you could keep, the point I'm trying to illustrate is you could keep one leg open and the other leg hedged. One leg hedged and the other leg open. That's the advantage, and that's how you should. That's always how you should manage your hedge exposures. When you're running a dynamic hedging strategy, that's how you should manage it. So you have intermarket spread we discussed, okay, and intramarket time spread, intermonth spread, which we also showed you, okay. Yeah, so more examples of intermarket spreads. Okay, so sometimes airlines, which have, we'll have this discussion more. We should actually have done this discussion, but it's a conceptual discussion. But airlines are basically short jet fuel, okay? You know what jet fuel is? What the stuff you put in the airplane to make it fly. It is basically, chemically, it is like very similar to kerosene. So it is derived by distilling crude oil. And so this jet fuel that airlines, the airline position actually is short in jet fuel because they have to buy it. So what they do is, therefore, they hedge it by going long crude futures. So if you remember here, this guy had already introduced you to the idea of the offset. Okay, so therefore you should have it has the effect of offsetting the exporter's risk. So whatever is the original, the underlying exposure risk, that your hedge should be used to offset the underlying position. So that was the idea that we discussed the other day in the previous class, that the hedge position should always offset the risk of the underlying position. So therefore, what they do is, to offset the short jet fuel position, they go long crude futures. So now what happens is, this jet fuel and crude, okay, the reason they do it is because, we'll discuss this when you're doing basis risk, because there's no jet fuel futures market. So if you directly go into hedge jet fuel, you can still get OTC market solutions, but there's not enough liquidity, okay? But in crude oil futures, you can trade very actively in high volume any time of the day, So therefore, for an airline, they feel like, maybe I should show you the chart. Uh, uh, Basis risk. Like this thing is working, right? Okay, yeah. Okay. So here's the price between. Let's reduce this a little bit. Yeah. So the airline looks at this price. Their exposure is actually to jet fuel, the black line. But here they've given the crude oil price as Brent, which is the North Sea grade of crude oil, the North European grade, while not the American grade. Okay. So here what is happening is that the airline looks at it and says that, if I try to directly hedge in the jet fuel market, I don't have liquidity. But crude oil futures are very liquid, and look at the prices; they tend to move kind of together. Okay. So I think I can handle this difference between the two prices. I'll live with it. Okay, let me hedge in the more liquid market. So they hedge in crude oil. Okay, the actual exposure is in jet fuel. So what this guy has is, now if we go back to where we were, I think we were somewhere here. No, I've got lost now. Where was I? Position exposure, outright position and here. Okay, so we were here. Let's open it back to 125. All right. Okay. So here we were talking about different markets. Yeah. So what has happened now in the airline? They started with a short jet fuel underlying exposure or underlying position. They hedged it by going long West Texas crude futures. Okay. So now they don't have that original short jet fuel position anymore. That was a outright position because it was directly a short in a jet fuel market, which can't be broken down further. Short jet fuel, long US dollars. That was the position. Now what did they do? They went, so they had short jet fuel, long US dollars, underlying position. They are trying to offset it by going long crude oil, short US dollars. So here short fuel, long USD. Here they went long oil and short USD. So the two long USD, short USD cancel out. Net position is short jet fuel, long crude oil. Okay. Okay. So now has a spread position. Spread position. Let's write it. What is the spread position? Short jet fuel. I don't need that inverted comma. Short jet fuel. The spread position is now they have long. Let's leave out the long crude oil. Okay. Right. So what did they have? They initially had short jet fuel, long USD. They hedged it by selling USD and buying crude oil futures. So now they have short jet fuel, long crude oil. That's their exposure, and that's their net position now. So this has become a spread position. So they started with the outright position as an underlying position. They did. They entered into a hedge in crude oil, so they've ended up with an intermarket spread, which is a spread position, which is an intermarket spread because jet fuel is one market and crude oil futures, crude oil is another market. Okay, so crude oil versus US dollars, one market. Here, jet fuel versus US. And jet fuel is not the same as crude oil. Okay, this is like kind of like the difference between yogurt and milk. They're not the same. Okay, yogurt is derived from milk, but they're not the same. So this is now you have a spread position. Okay, now intra-market, this is intermarket here. Yeah, this I already discussed with you, right? That you go long 1 month and you go short July, long October, or long May, short August, whatever, based on your view. So what you're doing is you're taking a either you're based on your view, or you have some trade commitments. Maybe you have some trade commitments and you find that it's easy to hedge with a spread position based on the exposure that you have in the business. Okay. So, but you can also trade these spreads speculatively. Many speculators trade spreads, commodity spreads especially. They take views on the spread. They look at May versus August and they say, oh, well, the spread is too wide. I think it's going to collapse. So these two prices are going to come together. So let me sell the spread. That's what they do that kind of trading. Okay, so there's also a type of style of speculative trading. Right. So as we said here, the volatility is much less. Okay. So we are talking about. So we had this long discussion on outright positions and spread or differential positions. Okay. Now let's see what we have to do now. Players in financial markets, we don't need to do it because you already should be familiar, but remember that now you'll see what the underlying meaning is. Arbitragers don't end up with a position. Instantly buy, sell, no net position, pick up riskless profit. CRA, okay? Okay, CRA. Hedgers. Hedgers are looking to decrease their risk, first transaction and decrease the total risk, okay? Have I described what total risk is? Okay, now this total risk has to be explained. Therefore, we have explained it in the note yesterday, when we had day before yesterday when we had the discussion. Okay, we have explained it here. So there is a little bit of a scrappy note structure here. We have a few notes here, and then we move to the big note here, which I will put into your folder. Yeah, total risk is this. We can make use of this. We can take it and put it here and say, no, we are talking about players in financial markets. Okay. So let's write it here. Total risk is equal to risk on underlying position plus risk on hedge position. Okay, so you have some idea. Now we'll still explain this properly, but I think by now you have some flavor of what is meant by. See how poor the connection is. It's reconnecting. At least I'm glad to know that Geo is a general problem with Geo, and it's not just my. Sometimes a particular location goes off the grid or something. So at least not my problem, and it's happening all over the country. A small consolation. Okay. Where am I here? Okay, arbitrageurs, hedgers. Now they're trying to decrease their total risk. Now what is meant by total risk? I should put a little asterisk here. Total risk. What is total risk? Total risk is the risk on underlying position plus risk on hedge positions. Okay. In case of speculators, usually there is no generally. Okay, I'm going to clarify it. Okay. Generally, why am I writing? Please note all these tricks. When you write later on, when you're working in industry, when you're writing memos, notes to customers, to internal customers, please use all these tricks. Why did I hedge myself by saying generally? Generally, speculators don't have hedge positions, but sometimes they do. That's why I use, if they never have hedge positions, then I would not bother to use this word. So I'm using this word because there are certain cases where speculators, I think I explained to you earlier about when I think Mitali was asking a question at the end of the class in one of the courses. I talked about how she could hedge her underlying positions if you didn't want to sell the shares. You can hedge it by selling futures or buying options, etc. So generally, speculators don't have hedge positions, okay? Generally. That's why I'm using the word generally, because sometimes they do. So this statement is meant to cover me for those sometimes when they do. So please remember how to write, okay? Remember how to cover yourself when you're writing about things. Okay. Generally, speculators don't have hedge positions. It should be S. Okay. So therefore, for hedge positions, for speculators, what will happen is total risk is just the risk on the underlying position. Okay. There is no hedge position for speculators. So hedge position is zero always. So the total risk, therefore, is underlying position risk, which is basically the total risk. This is a bit like option price, which option which is out of the money. So there is no intrinsic value. So all the value is coming from the time value. So in that sense, speculators, total risk is equal to risk on underlying position, except for some cases where they behave like hedgers, okay, which we've talked about in the part on option trading. If you remember your note on option trading, we have a section on that. Please go back and revise that if you don't remember. Relationship between the S&P 500 and VIX prices, implied volatilities. Okay, there we have that relationship based on hedging behavior. Okay, so that's the situation where we have hedge positions. Okay, 1 minute. Has gone. Okay, so your class is dismissed now, and you can leave, and I will put the notes in your folder. So does anybody have any conceptual questions? First, we'll deal with the conceptual questions, but the rest of you can go. I have taken care of, I have inserted the, at Vipul's reminder, which is a good reminder, I have put a link to your attendance sheet, but I have not updated the attendance yet. I will do that. Meantime, please keep track of your attendance. Okay? Yes. Anybody, any conceptual question? No? Okay, fine. Any administrative question? No? Okay, good. Okay, in the last class, I remember, I don't know if the person is still here, as I had already, I hit the end button and I heard a girl's voice saying, sir, and then it got cut off. I could not respond, and then I went back in, and I don't know who it was. Was it Mithali, or I couldn't identify the voice?
No, sir.
Okay, somebody asked a question, but I had already clicked on the end button, so it disconnected, but I could hear her voice before it got disconnected. Anyway, I guess if it was important, they would have asked, they would have called me. So if something like that happens, just call me, just email me and set up a call, Zoom call or something. Okay, I'll see you guys later then. I'll see you guys next week.
Thank you, sir.
Take care, bye.